Most people don't worry about annuities because they dislike them. They worry because they don't understand how they're taxed. And honestly, that confusion is completely reasonable. When people start thinking seriously about retirement income, the conversation often shifts. Not how much have I saved, but how will this actually show up in my life? Monthly income, predictability, less stress about markets. That's usually when annuities enter the picture. And that's also when the quiet anxiety starts, because annuities don't follow the same tax rules most people are used to. Today, I want to walk through those rules calmly and clearly. No selling, no scare tactics. Just enough understanding so you can place annuities in the right mental box. If this kind of clarity helps, you'll probably enjoy the rest of the channel. Subscribe for weekly videos and check the linked resources in the description. Now, let's look at these key principles. Key principle number 1. Tax deferral isn't a free lunch. One of the biggest features of annuities is tax deferral. In simple terms, money inside an annuity can grow without being taxed year by year. That sounds familiar because it's similar to how traditional retirement accounts work. But here's the part that often gets missed. When money comes out of an annuity, it's generally taxed as ordinary income, not capital gains, not special rates, just regular income tax. So the benefit isn't avoiding taxes forever. It's about when you pay them. Think of tax deferral like a pause button, not an eraser. Key principle number 2. Not every dollar you receive is taxed the same way. If an annuity is purchased with after-tax money, the payments work a little differently. Each payment is usually split into 2 parts. One part is your own money coming back. The other part is earnings. Only the earnings portion is taxable. This split is calculated ahead of time and slowly changes as more of your original money is returned. Early on, a larger portion may be considered non-taxable. Later, more of each payment becomes taxable. The important takeaway isn't the math, it's the principle. Not every annuity dollar is taxed equally, but over time, the tax picture evolves. Understanding that prevents surprises. And key principle number 3, annuities don't escape retirement account rules. Where the annuity lives matters. If an annuity is held inside a traditional retirement account, like an IRA or a workplace plan, it generally follows the same required withdrawal rules as those accounts. That means at a certain age, distributions are required, whether you need the income or not. There are specific structures designed to delay that income far into later life, but those are narrow tools, not blanket solutions. Okay. Here's the bigger idea. An annuity doesn't automatically simplify taxes. It just changes the timing and form of them. Deeper reframe. What annuities are actually for? Here's the mindset shift that helps most people. Annuities aren't primarily tax tools. They're income shaping tools. They trade flexibility for predictability. For the right person, that can be calming. For the wrong use, it can feel restrictive. Taxes matter, but they shouldn't be the sole reason something exists in a retirement plan. The better question is, what role is this money supposed to play in my life? Income floor? Longevity protection? Psychological peace? Once that role is clear, the tax rules become manageable instead of intimidating. You don't need to love annuities. You don't need to avoid them either. You just need to understand what they are and what they're not. When you do, they stop feeling mysterious and start feeling optional. And optional is a very comfortable place to be in retirement planning. In future videos, we'll talk more about how different income sources fit together, helping your retirement planning. Until then, clarity beats complexity, and calm usually follows close behind. Thanks for watching.